Here we go. What happened to the discount? So discount basically decreases as it is allocated to interest expense through amortization. Remember, our entry would be interest expense, right? We will record interest expense, but we will pay hard cash according to the contractual payment, interest payment. So we record in our books this, and we pay actually this, and difference is amortized. How we make the entry? Now that's a challenging part. So you understand right now that how the bond amortization schedule is made. So let's talk about this entry. So this basically the graph shows us that the interest payment is a smooth out because it is based on the fixed amount. So this basically tells us that at the end of the period, what happened? The interest expense is greater than the interest payment. You see, at all level, interest expense are greater than the interest payment, and the bond value must be equal to at the end the face value. That's it. So it means when bonds are issued at a discount, after some time its value starts rising, and at the end of the 5-year or 10th payment, the value would be equal to 100,000. Why? Because the discount is also adding at each point. So now question, the challenging part is that how we make the entry. Like I told you, we record in our books interest expense, right? Payments, so this is the hard cash that we pay to our bond holders. So this is recorded in cash, this is recorded in books against discount. So what would be the entry? We pay cash 4,500, cash is decreased by 4,500. We pay interest 4,807, interest increase, debit. So interest expense 4,807 to discount decrease, like we decrease the discount here. So that's why discount is decreased. So we make a credit. Increase in discount, debit, decrease in discount, credit, right? And cash 4,500. So in that case, debit is equal to credit. Right, guys? Again, I'm gonna explain one more time. So how we are going to account for? Interest payments are based on the contractual obligation. So when you pay the interest, these are payments, these are cash, not the expense. Remember that one. You pay actually how much? 4,500. And how much you record the interest expense? Interest expense you record 4,807. So how much you pay? You pay the cash and credit 4,500. Your expense, if this entry is not balanced, it means the difference is called discount, decrease in discount, which is 307. In that case, your entry is now balanced. Right, guys? Let's move forward. So on the next payment is on January 1st, but we are closing our books of accounts on 31st of December. So it means this is not the cash payment, this is the payment that will be made on 1st of January, not on 31st of December. So we create a liability. So this entry would be interest expense 4,823 to our decrease in discount 323 and interest payable. The only thing is that there is no cash here, only interest payable. Why? Because payment is on 1st of January, not 31st of December, but we are closing our books on 31st of December, right? Now, answer this question. What would be Southwest Airlines 2004 income statement and year-end balance sheet reported on these bonds? So on these bonds, their income statement stated the interest expense 4807 plus 4823, and their balance sheet shows the 4500 as a payable, right? Because we will pay this on 1st of January and balance sheet is made on 31st of December. That's it, right? So in order to evaluate, in order to account for or making entries of the bonds payable at discount or at premium, be very careful regarding the interest expense calculation, interest payment calculation, and the dates. That's it. And the long-term liability is 100,000. Discount that is left 3221. So on after 1 year, the bond value have increased from 961492 to 96779, right? Okay, so I'm just going to give you this illustration. All you need to do, just pause the video and do this example. I have pasted a solution, so you can compare the solution afterward. If you have still any confusion, please do write us in our WeChat group so that we can just sort it out what happened here. So I'm just going to read that one, and you are required to answer the question here. So is the Chamora Limited is authorized to issue 600,000 of 5%, 10-year bonds payable. So this is just for the information because they have just authorized from the institution, from the SEC, the Security Exchange Commission, that they are maximum authorized to issue 600,000 bonds payable, right? On December 31st, when the market interest rate is 6%, the company issued 500,000 bonds payable and received 462,808. What does it mean? It means the market interest rate is higher than the coupon interest rate, right? Your coupon interest rate is 5%, your market interest rate is 6%, you issued 500,000 and you received 462,808. So prepare a bond amortization for first 4 semi-annual payments. So pause the video and try to answer this question here. And at the end, record issuance of the bonds payable on the 31st December 2014, the first semi-annual payments on June 30, and the second payment on June 31st. Remember, they are not paying on 1st of January. They are paying on the last of December. So there is no interest payable. Interest payable. There is only cash here. So this is how we make the first 4 interest payment and interest expense collections here. So how we did that? So on issuance, we received 462,808, and this is our discount. So 2.5 is based on our contractual payments, 5% divided by 2, and interest expense is based on market interest rate, which is 6%, semi-annually divided by 2, which is 3%. So this 12,500 is coming from the 500,000 face value, while this $13,884 is based on the bond value, which is 462,808. The market interest rate is based on the market values like this, the preceding market values, but contractual obligations are fixed. So please compare your answer from this solution, and please do write us if you have any question regarding over this illustration. So now the recording of the bonds payable. So you receive 462,808 and your obligation is 500,000. So when you issue the bond, you receive cash, cash increase, debit 462,808, and your liability, bonds payable, it is 500,000, and you discounts on bonds payable, which is 37192, which is the difference between cash received and your obligation. In that case, your entry is now complete. So for better handwriting, let's see here, cash to discount on bonds to bonds payable. Right, guys? This is how we solve this issuance of bonds according to entries, and we make some entries. This is the treatment of bonds payable issued at discount. So when you record the first semi-annual interest payment, so remember that interest expense is recorded, interest payment is your cash payments, right? So you are paying on 31st of June. How much you pay the cash? Cash paid 12,000. Cash decrease, which is credit, and interest expense. When expense happen, always debit. Expense increase, debit. So this is interest expense, which is 13,884. So the difference between these two is 1,384, which is the decrease in discount on bond, which is how you balance your accounting entry as well. So debit is equal to the credit. Let's see our entry here. Interest expense to discount on bonds to cash. Here we go. Right, guys? And what about the second payment? So second payment is on 31st of December, and we close our books on 31st of December, so there is no interest payable. Entry is the same, interest expense to discount to cash, but figures are a little bit different. Why? Because now we are paying second one, and this interest expense is based on the preceding bonds value, which is 3% of 464192, right? Only the figures are changed, entry is the same. Now partial payment period interest payments. So Google Incorporation issues 100,000 8% bond payable at 96. What does it mean? This bond is issued at premium or at discount. Since it is quoted less than the 100, it means it is issued at discount. You don't believe me? See this one. The market